Hi everyone, Milad Reza here. In today's video, we're going to talk about insurance inside super. So anyone that's got a super fund, chances are you got some default insurances within that. So you got some death cover and total permanent disablement cover. And in most instances, you will find that there's some income protection as well. Default insurance is better than not having anything. But if you're looking for peace of mind, this is a very important video to watch because I'm going to reveal the difference of having proper insurance providers attached to your super, where your super still pays for it, versus default covers that come with your super. Now, if your super fund is doing everything, your admin, your insurances, your investments, are they doing a great job with everything? Probably not. You find there's a lot of big gray areas, definitions that are a bit washed down, and it can catch you out. So in this video, we're going to talk about those differences. So the first one is when you have death cover and TPD. Now, death cover is just in the name. If you were to pass away, your loved ones get a bit of money to make sure that they're looked after financially. If you've got the right amount of cover, that is. The default stuff, whether it's actually the right amount, it's questionable. But the bad news is that most super funds, you'll find that it's linked and you can't actually unlink them. So your TPD cover, total permanent disablement cover, and your death cover are linked. So if you claim your total permanent disablement cover, your death cover also reduces by the same amount. And in most instances, those covers are actually the same level. So if you got $300,000 of TPD and $300,000 of death, you claim $300,000 of TPD, you leave your family with nothing. And most people are unaware of that. So that's a big one. Now the TPD cover, total permanent disablement cover, it's a cover that if you end up in a wheelchair in a really bad way and you can't ever work again because of that, very hard to claim, but very important cover as well to have. There is a definition inside super that catches most people out. It's called any occupation definition, which means the insurer will assess you based on experience, knowledge, and training. And what that means that, let's just say you're now a qualified accountant or a surgeon or a lawyer, but back in the day you worked another job that has nothing to do with what you're doing now. If you can still do that, they'll say, well, you can do that. So decline. A lot of people call this the McDonald's definition because, we all had those first jobs, second jobs that weren't that flashy. So, it's very important to note that this definition can really catch you out. Now, the opposite side of this is own occupation. You can't do what you're doing now, so that's how they're going to assess you. You can't do your current role. You can only get that sort of cover outside of super with providers that are just doing insurance only, not, default insurance inside super. But with the right advice, you can set it up so that your super still pays for most of that. As opposed to you paying for the full amount to get access to own occupation TPD. It's quite important. If you're going to have peace of mind, get the right covers in place. Income protection. Income protection is you can't work for an extended period of time due to injury or illness. And it's a cover that is meant to replace your income. It only pays 70% of your income to give you a bit of an incentive to go back to work, but a very important cover because most people, without their income, they're pretty much stuffed. There is no replacement. There's no substitute. So income protection, the idea is to have exactly your salary covered. Most people, the insurance they have inside super hasn't been updated. Might be from like 10 years ago. And, they've had 10 pay rises since then. So the other side of it is that there is a waiting period and there's a benefit period. The waiting period is, well, how long do you have to wait before you get assessed to whether you can work or not? So usually it's 60 or 90 days within super. Usually it's like a longer waiting period, like 90 days or 2 years sometimes. How long can you go without an income? Ideally, you want 30 days. So after 30 days, you get assessed. And if you can't work, then you can potentially claim there. And that, for most people, 30 days is the max they can go without any sort of income. The benefit period is also important. How long are you going to get paid? So once you have a successful claim, how long will they actually pay you out, the insurance company? Now, some insurances inside super, they're a bit cheeky. It's like a 2-year benefit period, 5-year benefit period. We always say age 65 is where it should be. You don't know how long you're going to be out of work for. So you don't really want to get 2 years of income, and then after that you're stuffed. You have to rely on your partner or your family or whatever it may be, the government pension, the government disability pension or something like that. It's not what you want to be doing. So they're really important to know. Now, when I'm talking about all of these different gray areas, the other solution to all this is an external insurance provider that just does insurances, and you can use your super to still pay for those premiums, but you got that great peace of mind because they have all of these stronger definitions. They have all these features that you can get access to. So age 65 benefit period, 30-day wait, own occupation TPD, all of these important vital features for most people. The other one is when you have death or TPD inside super, you find that your cover keeps decreasing with age. For most people, it catches them out, and they do this because they want to kind of pretend like your premiums aren't increasing too much. On the other side, they might say, well, your premiums aren't increasing with this cover, but you'll find that over time it keeps on actually lowering your cover. The provider keeps lowering your cover, which is not ideal because you want to make sure that you initiate that sort of lowering of your cover, not the insurance, not the super company. The other side is if it does stay the same, your premiums go up pretty drastically because inside of these default insurance covers inside super, there is no capability for you to sort of lock in premiums so that the increase is not based on age. It's only based on CPI and other factors. When the increase is also based on age risk, it can be pretty dramatic in your 40s, 50s and 60s, and that's when you really need it the most. Again, outside of super providers with insurances, they give you access to sort of a premium structure that it is a little bit higher to begin with, but over time it can save you hundreds of thousands of dollars. And I'll show you what I mean. This is a regular sort of premium structure for any default cover inside super. Looks pretty good in your 20s, 30s, but then it gets a bit crazy in your 40s, even crazier in premiums in your 50s, and even higher in your 60s. And this is realistically when you need it the most. But the premiums keep going up. It's not ideal. The other side of that is getting a premium structure that is initially a bit higher, but it only goes up marginally, and that's only because of factors like inflation and other bits and pieces, but not age risk, because that's where you get really caught out, like 20% increases annually, sort of thing, which is pretty full on later on in your life, in your working life. So to get access to this sort of premium structure B, let's call this premium structure A, again, you need to have a external insurance provider. There's about 10, 15 different providers out there that only focus on insurance, but it's not to say, well, go for these guys and then you have to fork out of pocket. You can still use a super and you set up basically like an automatic annual rollover from your super, so it funds the premiums annually, which is ideal because most people can't. Then for most people it'll be a bit of an issue to go, well, yeah, that's great that I'm getting better definitions, but now I've got to pay out of pocket. It's not the case. You just get a lot more you get a lot more benefits and stronger definitions and what you really need for peace of mind. We're only scratching the surface in this video. There's a lot to talk about when it comes to insurances. If you've got a family, if you've got any dependents, even yourselves, your income, you want to make sure that income protection is making sense. You want to make sure that it's covering your income. For most people, do they have enough cover in place? For most people, they don't even have super contributions cover. So let's just say you're out of work for 30 years in your working life. Well, it's not just that. If you're getting no super contributions, what then? What happens to your retirement? So having the right income protection in place, making sure it's covering your super contributions, because your income is your biggest asset. So you want to make sure that cover is doing what it needs to do. There is another cover, also trauma cover, and you can only get that outside super, so you don't have to pay for that out of pocket, but it covers things like heart attack, stroke, cancer, to name a few important ones. And we call it a short-term cover because if you're out of work because of those, chances are you want to sort of assess whether you want to go back to the same job. You can potentially have your partner alongside you during such tough times. And usually, you cover 2, 3, 4 years of your salary to give you that sort of breather while you're going through those circumstances. And really important cover. It is a very highly claimed cover. Again, you can't get that inside super. All the other 3 covers that we spoke about today, income protection, death cover, and TPD, you can get those inside super, which means your super fund pays for them. But you can't get trauma cover inside super. It's only available outside, but a very important cover for most when they realize what it can do for them. If you have further questions, if you're thinking, well, right now, I'm not quite sure what's going on with my insurances, we would sit down with you for 20 minutes, go through where you're at with everything. And then if you decide to move ahead with advice, we would do a needs analysis for you and come back to you with where are you now in terms of your covers, what have you recommended, what do those covers look like if you took them out with your current setup, who was the provider that we recommended, and who are the alternatives that we've considered as well. And they will be all based on needs analysis, which means we look at your assets, liabilities, and figure out how much you actually need and go from there. So the link's at the bottom. Lock in your 20-minute strategy session. It's complimentary. It's a great peace of mind for anyone. There is a lot to digest with insurances. Get someone that knows what they're doing, and you can just get on with your life and make sure that you got that peace of mind.